the Executive Director of SEBI, Mr. Vaidyanathan, members of the Motilal Oswal family, Mr. Oswal, Mr. Ramdev Agarwal, members of the National Stock Exchange, welcome to this ETF Conclave. David, you may be familiar with this, and Balaji, since both of you are from America, that in the 90s there was this aha moment when James Carville, who was the election manager for Bill Clinton, said that if he was reborn, he wanted to be reborn as the bond market. Because the bond market dictated policy, what the deficits were in America, what the tax rate should be in America, what the inflation rate should be in America. It was omnipotent, more important than Congress, more important than the president. The bond market controlled the financial economy. And switch forward to 2010 onwards, and the new financial kid on the block is ETFs. They run over $1 trillion under assets for a product that didn't exist about 10, 12 years back. There are more than 800 ETFs that trade in the US. So it's a very important and increasingly dynamic force that shapes financial markets, can cause rapid movements in various assets and commodities, whether it's gold, silver, or equities. The fact that whether it's rightful or not, be blamed for the flash crash explains how important ETFs have become part of the financial language of the world. So let me just start with a very basic question. When I was trying to understand ETF, the first question came up, and I'll ask you, David, and then I'll ask you, Nitin, about this, is that what is the difference between a closed-ended fund that trades on the exchange and an ETF?
Well, they both trade on the exchange. A closed-ended fund will not have a creation and redemption mechanism that enables the fund to issue new shares. So a closed-end fund starts out with an issuance of shares, and those shares are generally fixed for the life of the product, except for secondary offerings and things like that, but generally. And an ETF has what's called a function called continuous issuance. So every day in the life of an ETF, authorized participants or market participants can create new shares in the ETF or redeem shares that they have. What this does is critical because it enables the ETF to trade right around NAV because there's an embedded arbitrage mechanism. It's one of the last remaining pure arbitrages, if you think about it, because especially in an ETF where the basket and the ETF are trading at the same time, there's a pure arbitrage between those two products. And I think that, I refer to them as completely fungible. One really equals the other. That does not exist in closed-end funds.
Is the Indian investor at this point sophisticated enough to understand the difference between a closed-ended fund and an ETF? And David points of that true arbitrage can be created. Just explain that in a example.
So I think the Indian investors were very used to closed-ended funds till about 15 years ago, and one of the reasons why closed-ended funds became out of fashion was primarily because you would invest in them and you had no ability to take your money out unless you could find a buyer on the exchange. On the exchange, when you would try to sell the fund, it would typically trade at 20, 30, 40% discount to the NAV, which effectively means that you're losing a fair amount of value that has been created in the fund, or even if it's not been created, you're still losing value. And I think that's when they became out of fashion. What ETF does really is it blends the listed feature of a closed-ended fund, but gives the ability of an open-ended fund to then create and redeem units on a daily basis, just like you have on the mutual fund side. And because you can sell and buy ETF units on a day-to-day basis, this 20, 30, 40% discount shouldn't exist and doesn't exist. Yes, you will still have a 1-2% difference between the ETF price and the NAV, but that's a function of market supply demand. To give you an example, if you take any Nifty ETF or mid-cap ETFs, if the NAV of the ETF is 8 rupees, because you know the underlying 100 stocks and you know what price they trade at and what the composition of that basket is. If the NAV is 8 rupees and you see the market price to be 9 rupees, then there is a 1 rupee, as we call it, free lunch available on the table. Arbitrage opportunity. This is a pure arbitrage because this is risk-free arbitrage because you could easily buy one and sell the other. And that feature basically lends the ETFs to be effectively track the NAV pretty much as close as possible. And I think that's pretty much what ETF as an innovation has managed to do.
Right.